G'day, this is a video about my investment philosophy. What is an investment philosophy? It's a set of beliefs and strategies that guide investment decisions to achieve your financial goals. Everyone has different financial goals. There are many different financial goals. Make lots of money, protect your money, retirement, etc. What is the purpose of my investment philosophy? Increase certainty in retirement. Now mine is different. It's not the same as the current norm, which is generally pooled funds, which are basically set and forget. They're for inactive investors to close their eyes and cross their fingers. Pool funds will work if you have enough money or live on the smell of an oily rag, which is not much fun, and a lot of worry. Mine is for active investors who want to actively reduce risk, want to do something to protect their money and make smart decisions. Why is it different? Different financial goals. Let me show you why. Before retirement, money goes into super, so it grows. After retirement, money goes out of super, but you don't want it to go down like this. Before and after, are these two the same? No, they're the opposite. Different investment philosophy. Should you have a different investment philosophy for each of these? Yes. In retirement, do you want stable capital or stable income? Now, you don't want income like this. You don't know what to expect 1 year to the next. You want income like this, that's nice and stable and predictable. So in retirement, you can have stable capital or stable income. Different investment philosophy, do you think? Yes. Now this doesn't happen overnight. It takes time to build, so you need to start before you retire. Before retirement, you want to grow your super. Near or in retirement, you want to protect your super. Different investment philosophy? Yes. Let's look at market crashes. There's been 19 since 1870. That's on average 1 every 8 years. Only on average. Sometimes it's longer, sometimes it's less. Before retirement, if you have enough time, it will come back after a crash. Near or in retirement, you don't have as much time, so it may not come in back in time for you. Here's an example. This is the global financial crisis here. It took about 11 years for the market to come back to where it was at the top of or just before the global financial crisis. Do you have enough time? If you do, you can wait. If you don't, you can't. Should you invest differently? Yes. Now look at markets. Sometimes they're high, sometimes they're low. Should you invest differently? Yes. Interest rates. Sometimes they're high, sometimes they're low. Should you invest differently? You're probably getting the picture now. Yes. And the Australian dollar, sometimes it's high, sometimes it's low. Should you invest differently? Yes. So how is mine different? It's flexible, moves with the times, and actively reduces risk and take opportunities when the risk is low. How is it different? It's got an income focus. Now let's say you need this much money in retirement, but you've built up interest and dividends of this much, so you have enough, even if the market crashes. How is it different? We're not afraid of a market crash. We're hoping for one. Because when there's a market crash and you buy, you do well. How is it different? It's not a pooled fund where everything's bundled together, some shares, international shares, property, etc. Do you call that a diversified? I don't. It's just one fund. We have separate investments that pay income. It's more diversified and safer. How is it different? We actively reduce risk by selling bad value when the market's high and buying only when it's good value. And that doesn't mean when it's down, that just means when it's good value, because it's not always good value when it goes down. And when the way we do that, when the market is bad value, we have less in shares. Might have none, at times we do. When the market's good value, we increase the amount in shares. The green bit there is shares and property. See, bad value, good value. How do we do this? Well, we use the value adjusted risk reward ratio, or VAR. This is actually an invention of mine. And what is VAR? It's my adaptation of the risk reward ratio, which is the ratio of the potential risk in a portfolio to the potential reward in a portfolio, adjusted for the value of the market at the time. And this is what it looks like. So at this time when I did the video, the potential reward of our portfolios is 7.5 and the potential risk is 3.4. And you'll see that this is more than 2 times that, and that's what we're looking for. That's the ratio we're looking for. We want something where the reward is 2 times more than the risk. So when the market's bad value, we adjust our portfolio. When the market's good value, we increase our portfolio so we can take advantage of the good value. Investment philosophy outcomes. This is what you're going to get. Sufficient income for your lifestyle, income that lasts longer than you do, and a high degree of certainty. It's not just about returns. It's not even about returns. It's about creating a sense of confidence, security, and peace of mind in retirement. Remember this, investment philosophy is a set of beliefs and strategies that guide decisions to align with your financial goals. So what are my beliefs? This may take a while. They've been developed over 30 years. I've seen what works and what doesn't, and I've listened to smarter people than me. So my beliefs, simple investments are best. Facts are more important than opinions. To find opportunities, you must look. Discipline is the key to success. So you can have a plan and you can have a philosophy, but you have to stick to it, and that requires discipline. If it's too good to be true, it's not true. You make your profit when you buy. The unexpected does happen. The unexpected cannot be predicted. It is better to be safe than sorry. Markets are driven by emotions, not logic. My beliefs, risk is increased by clients' uncertainty, a lack of trust, acting on emotion, false information, and lack of understanding. Risk is reduced by diversification, buying good value, selling bad value, income producing investments, flexibility, using index funds, and looking long term, and making sound, logical decisions. There will always be another market crash. They're a fact of life. No one knows when, and they're always triggered by the unexpected. A market crash can be a great opportunity if you're ready for it. So these are my investment strategies. There's a lot of them. I didn't want you to, just want you to know at this point that there's just a lot of them, and they're all used to reduce risk and increase certainty. I'll have videos explaining them all on my YouTube channel eventually. It'll take a while. All of this is a waste of time if it doesn't work, and all my clients have done well with what they've had. They're all confident their money will last, and they have peace of mind. Here's some facts. This is a performance report of a client's portfolio, and it shows returns net of all costs and admin and advice fees, which means this is after I've been paid. And you can see here over 3 years, this is up to September 25, 9.67%, whereas the benchmark, which is like the average, got 5.27. And since it started, which is just a little less than 5 years, 6.29, which is about 4% better than the average. And this is what it looks like. The dark line here is the client's portfolio. That's the results. So how do we get that? You can see here, at this point here, we reduced the amount of money in shares, and that was good, paid off. Even though didn't get much of a return, it's better than going down. And then here, the market was good value. Sorry, we reduced it there because it was bad value. Here, the market was good value, so we bought in. And we bought in at this point here, and it still went down a little bit. But we increased it to about 70% in shares and held on to it till there. The market was very bad value, just about the time Trump was elected, and we reduced it down to 30% in shares. If we hadn't done that, it would have gone down further. Now the good thing about all this is we did it with low risk. Most of the time we only had 30% in shares. It was only between here and here where we had more than that. So it was reduced risk and got better returns. So before 21, we used a different super fund. So here I'm going to show you some returns from the COVID crash. So this is one portfolio 10 months after. They got a 37% return. 12 months after, they got a 30% return. 13 months after, a 30% return. It has worked well so far. It doesn't always work short term. Long term, it seems to. Would you like to know more? Check out my website or my YouTube channel, or give me a call. And here's a general advice warning. This is the simple Gavinized version. This presentation is for educational purposes only. The information is reasonably accurate. Some poetic license has been taken to a small degree for explanation purposes, to make it easier to understand. Get advice from an expert before doing anything. The next one is the official version. I'm not going to read all this out. I'm not going to wait here long. If you want to read it, just pause the video here and read on. And remember, you can be confident that you will always have enough money. It's possible. Thank you.